Welcome back, guys, and in this video we're going to be discussing basics of wick. In the previous videos we've discussed how candlesticks are formed and the four major points on a candlestick. By now I'm very sure you know what those four price points mean. In this lesson we are going to be discussing wicks, and this is also called shadow. So a candlestick with a long upper wick and a short lower wick indicates that buyers in the market bid price higher. So what this is telling us, this is the particular candlestick we are talking about, the long upper wick. So this shows that there was a time price was here. That was when the candlestick was forming. There was a time price was at this highest point, which is the high price. But for whatever reason, the sellers drove the price down. And what do we mean by sellers driving price down? It means that at this point, sellers started selling. And when there's a lot of selling in the market, or there's a lot of sellers in the market, the price will drop. That means that there's more supply than demand. So there was a time price was here, and then sellers started selling, and then they were able to drive the price down to this region. So the price opened around this area. When price opened, then it went as high as this. So later, sellers started selling and drove the price back below where it opened, very close to where it opened. Let's check it out in a real life scenario. So we're going to be using this particular candle as an example. So check this candle out. It has upper wick, and this upper wick, as I said earlier, represents the activities of the seller. So when this candle started forming, the candle opened here, which was the opening price. It went as high as this. When the price was as high as this, it was a full candle, right? It was a full candle. Then sellers started driving the price down. There was a huge sell-off in the market, so they drove the price down back to this level, which was the closing price of that trading session. So the price opened here, closed here, but went as high as this. This basically shows the activities of the sellers in the market. So when you see a long wick, it means there are so many sellers at that point in time, more sellers than buyers. That's basically what it means. And the other one, which is the lower wick, a candlestick with a long lower wick and a short upper wick indicate that sellers in the market bid price lower. So there was a time price was as low as this, which was the lowest level. It was as low, then buyers started entering the market. So there were so many buyers in the market than the sellers, then price went up, because when there are more buyers than sellers in the market, there's a lot of demand and supply. When there is more demand and supply, price will go up. So that was what happened here. So for example, in a real life chart, this is what it looks like. There was a time the price was very close to this area, was at the lowest point, which was like a red candle. But at the end of the day, buyers entered the market and started pushing the price up. What do we mean by pushing the price up? There's a lot of demand. When buyers enter, they keep buying until price went up to this extent and closed. You can see that the opening price was really close to the closing price. This represents the activities of the buyers, and once there are so many buyers in the market, you expect the chart to go up. Do you understand? That's basically what lower and upper wick does. So when you see a long upper wick, it represents that sellers are so many in the market, and when you see a long lower wick, it shows that there are so many buyers in the market. I hope you understand the basics of wicks. Lower wick represent the buyers and upper wick represent the activities of the sellers. That will be all for wick basics, and we'll see in the next video.